Manish Sonthalia joins us, and let's say hello and good morning to him. Manish, it's
Morning.
incredible, isn't it? 2 weeks ago, there was helter skelter, risk off moment in the world, but the force with which global markets have made a comeback looks like there's no worry in the world.
Because that's the whole problem that the market just keeps on fluctuating between a risk on and a risk off. And but as far as India is concerned, I don't think this market is going to fall until and unless you have too much of excesses created in this market. Every dip will be bought into because you have a net SIP inflows of closer to 10,000 odd crores, gross inflows of north of 20,000 crores. You have a situation where broader markets, there is no option to short sell. So what is expensive because of flows just gets bought into and it becomes more expensive. So I think that's the world that we are living in. And obviously macros globally, apart from the Middle East tension, seems to be now on the course to see a rate cut sometime in September, October. And of course, that is also one of the factors where you have a risk on trade come through. And what I believe in media reports is that yen carry trade unwind is more or less done. Some 60, 70, 75% is already over. So again, that's fueling a risk on trade. So from that point of view, I think it is a stock pickers market. You can't really say that the valuations on the benchmark indices are too comfortable. Uh, you know, Probably we are discounting FY26 EPS as we speak, which is a bit too early. And the other important metrics which Warren Buffett commonly follows, the market cap to GDP, that has now crossed 127%. The last time we peaked for a very long time was 140%. So all in all, on the benchmark indices, if you were to move another 10-12%, we would hit that number. So I would say that because of the flows, etc., it is a stock pickers market. We got to find valuations comfortable. And today in the markets, you'll have only 25% of the stocks where valuations you could say are somewhat comfortable. For the rest of the market, you have to dabble with valuations first.
Manish, why there seems to be this sudden frenzy in these new tech companies? Zomato, PB Fintech, Ola. Nobody wanted to subscribe to Ola issue 10 days ago, and now from the issue price in 6, 7 trading sessions, it has doubled.
Yeah, so it is all a relative game. So seeing the listing, of course, if you could just make sense on the numbers, I mean, they are currently, at half the valuations of the largest, or half the market cap of the largest motorcycle company in India. So from that point of view, if and they are not making profits, by the way, and if loss-making companies are getting valued in this way, then obviously the other platform companies ought to deserve more. I mean, that is the thought process. I think nothing fundamentally has changed as far as platform companies are concerned. But I think the rate cut environment speaks it bodes well for IT companies, tech platforms, and obviously these are all tech platforms where they are seeing a rub off impact on the positive side because of the impending rate cut and because of the fact that IT is making a comeback, technology is making a comeback.
Given the run up in the market, Manish, are there any spaces where you've eased off positions or recommend avoiding, for instance?
So I think this capital goods space, even though defense, railways, I mean it's a story which has played out far too fast, far too soon. And I think there will be consolidation that's going to happen out here. And there's too much of money that has chased too few stocks in this space, and everything is beyond comfort levels in terms of valuation. So the macro theme out here is pretty decent, but I think probably the stock prices are discounting next 3, 4, 5 years of earnings, which to my mind is a bit too early. And in the interim, if you see the story not playing out as anticipated, particularly in railways or defense, then obviously you'll have a bigger cause for disappointment. So this is one space where I think there is discomfort in terms of valuation.
Okay, so that's one space, industrials, etc. But what about autos? Do you think the best is behind? Whether you're looking at the reports coming in about the inventory being high, the waiting periods coming off, discounts being on the higher side, and the fact that these stocks are not cheap by any yardstick. In fact, last couple of years have been very kind to them. What would you do with the auto sector now?
I think the next big hope is the festival season. And yes, you're right that inventory levels are pretty high in the system, both two-wheelers, four-wheelers. But there is hope that, second half of this year, because of the festivities and because of decent monsoons, we're likely to see a pickup in discretionary consumption. And from that point of view, the problems of overvaluation or over inventories will get eased out. The inventory position is already reflected in the prices. It is a pickup in demand, which is actually likely to see an uptick in prices from where we are. If the demand is not going to come up in the second half of the year as anticipated, then you'll have a bigger reason to see the correction come through. I think the best way to play autos at this point in time is not the OEs. There could be select few here and there, but the auto comp space. India is becoming a global hub in terms of automotive exports, and also domestic demand is pretty decent. So out here, it is a pick and choose between valuations and how the growth outlook looks. So this is how I look at autos currently.
Your top holdings essentially are from the pharma space. Sun Pharma, Divi's. These are not exactly stocks which you can call them as value, right? I mean, Divi's is, Kotak report last week talked about valuations are absurdly high. I think they use the word absurdly high. Sun Pharma again, mid 30s. Why do you like pharma?
So I think, the time of pharma has come in terms of growth. And obviously, when you look at the rest of the market, even now the valuation comfort is there. So these are not value stocks, these are growth stocks. And as and when you see, some pharmaceuticals is basically a play on specialties. New specialty molecules are actually coming under their platform. And, the base business, the India business and the US generic business continues. Of course, they have problems in the facilities. The US FDA warning letters are there. That's a problem. But I think they are doing well in terms of mitigating the impact from the specialty portfolio. And obviously, they are by and large the largest pharmaceutical company in India, where the IPM is growing at 10-11% in value terms on an ongoing basis. So I think there's comfort in valuations vis-a-vis the growth. Divi's again is a API player where growth has been very decent. And I think the commissioning of the Vizag facility will mean that they'll drive value as well as volume, and which in turn will earn margins. And the next round of capex is already due. And as you would know that as and when they announce the next round of capex, that the stock tries to find its level in terms of what the asset turns are going to be and what are the margins that are going to get built on that new capex. So I think it's again extrapolation of growth. So I think on a relative basis, pharmaceutical is still an area where there is decent growth and valuation has not yet got fully discounted. This comes on the back of destocking in the pharma space globally, and also the specialty chemical space. Agrochemicals, by the way, is looking like bottoming out, not so much in specialty chemicals. And pharma obviously looks like having bottomed out in terms of destocking. So I think it is to do with growth, and that is how this sector is likely to make a comeback.
15% higher for Nifty Pharma. So, Manish, another way of looking at pharma is the lean towards domestic companies, pure MNCs or pure companies like a Mankind or perhaps Cipla to some extent, which have a less exposure to US market. Is that a good strategy? Look at Indian companies. That's why, pricing problems are not there, cycles are not there, the insurance volatility is not there.
You could look at that. I mean, every aspect of the pharma value chain, whether it is, let's say, your CDMO players, you have specific plays out there. In terms of Indian pharma, again, I would believe that there is a case for leaning more towards chronic as opposed to acute, because there you have a very good comfort on margins vis-a-vis acute portfolio. The entire APM market may be growing at 10 to 11% in value terms, 5 to 6% in volume terms. But I think the growth is going to be faster in the chronic segment as opposed to the acute segment. Both are very profitable segments. So plus OTC portfolio, plus trade generic. So I think you can't really generalize this whole space, but it is about individual companies, which are the areas where they are specializing, what is their right to win, and what is the valuation. So from that point of view, each company will have its own nuances. You'll have companies in the chronic space which are doing extremely well because of their product portfolio. You'll have players in the acute space which are doing very well. They have a large portion of trade generics which are very profitable in these days, plus OTC products. You'll have players in the CDMO space where they are having good growth visibility over the next 2, 3, 4 years, and obviously because of the Bios Pharma Act that's come out in the US, Indian CDMO guys are going to have a right to win. So from that point of view, if you position yourselves early in the cycle, you're likely to be a beneficiary when the growth comes through in the next 1, 2 years. Of course, the pipeline, the molecules, what is going to get commercialized, phase 3 clinical trials, what is the depth of the molecules out there, that will all determine. On the other hand, you'll have diagnostics, which again, to my mind, looks like a bit too stretched in terms of valuation, but definitely you have a play out there. And then obviously you have the US exports, and there again, the base exports as well as your specialty portfolio. That is all going to differentiate the entire pharma space. Too large a space to generalize, I would.
Manish, on that note, we let you go. Thanks so much for making time and speaking with us today. So that's the market view coming.
If you like this video, then like, share and subscribe to ET Now.